Webinar is entitled, How Changes in Tax Laws Affect Income, Estate, and Charitable Gift Planning. Our presenter is Craig Smith, Associate Vice President of Development at Rochester Institute of Technology. Craig currently leads the University Development Team at RIT. In this role, he manages a group of 24 professionals in major gifts, corporate, and foundation relations. In his 8 years at RIT, his team has helped to raise more than $120 million. Before joining RIT, Craig worked as a senior consultant with John Brown Limited for more than 25 years. He directed client relations in higher education, the arts, healthcare, and cultural organizations nationwide, including the National Geographic Society, the University of Michigan, all the campuses of the University of North Carolina, and the Museum of Fine Arts in Boston. He has helped to develop and manage campaigns from as small as $6 million to as large as $2.5 billion. Craig is known throughout the fundraising community for his leadership, personal solicitation skills, and gift planning know-how, a skill he is bringing to you today. Craig, it's all yours.
Thank you very much, Lydia. I appreciate that. So what I want to share with all of you today are some ideas that I see people doing all over the country. Lots of wonderful families and individuals want to make sure that what they've worked for and put together financially goes to their children and their grandchildren, family members, even friends, people who are meaningful to them, obviously. And some of what they do is in the context of making personal gifts as well as charitable gifts, which are encouraged by our tax laws. So I want to start with the notion of how you can make personal gifts to family members and friends. But before we begin, I'd like to put out a polling question because I'd like to know a little bit more about the group that's listening into this. Lydia?
I think that is coming up right now. You want poll 1. Thank you.
Yep.
Okay, so we're asking for an idea of where you fall in the age ranges listed. There we go. In the age ranges listed on the screen in the chat box. Under 40, 40 to 55, or 55 or older. And if any of you are shy, you can choose to not answer that question.
Okay. Great. Thank you. I appreciate knowing who's out there. So let me start first with the concept of giving gifts to family. Hang on, we got to get this in just the right spot, don't we? Okay. Hang on, we have to wait for the polling to stop. Great. All right. So the government allows you to make a gift of up to $14,000 annually to an unlimited number of people. It's indexed for inflation, so it'll rise over time. By the way, what I'm telling you, you'll be able to read in a follow-up document when we're finished with this, so please feel free to make notes. I'd love to take questions from you, but you can read this at your leisure when we're finished. So you can make gifts like this to children, grandchildren, friends, and it can be of any asset. The $14,000 does not have to be in cash. In fact, you can give everybody you know $14,000 each and then come back after January 1st and do it again and then again the next year. And if you're married, you can give $28,000 that way to as many people as you want. And this has a formal name. It's called the annual exclusion. Now here's the good news. There's no gift tax paid by you and no requirement that whoever receives such a gift from you need to report it as income. It's not like winning the lottery, even though it may feel that way to the recipient. The receiver never pays a gift tax upon receiving the money. So that's the annual exclusion. That's how lots of people reduce the size of their taxable estates and move money tax-free to children and grandchildren on an annual basis. Now, when you make a gift of more than $14,000 as an individual to someone in a tax year, you have to file a federal gift tax return. And when you do, the government looks at an account that exists in Washington for all of us, referred to as our exemption account. Now don't go to sleep. It's actually called the Unified Estate and Gift Tax Exemption. In any case, the number on the screen is what each and every one of us, either during our life or through our estates, can give away tax-free to anybody we want. And if you use up that much during your lifetime, you are then required to pay 40 cents on the dollar for anything that would exceed $14,000. In recent years, thanks to new tax laws, the maximum that can be given away tax-free has increased, and now it's at an all-time high. So if you were to pass away this year without having given anything away during your lifetime, other than gifts of $14,000 or less, then the first $5.4 million in your estate will not be subject to federal estate tax. This was made real in the 2012 American Taxpayer Relief Act, which set the exemption and indexed it for inflation. It also established the maximum 40% tax rate for estate tax. There was a particularly good piece of news in the legislation at that point. It established what's known as portability, quote unquote. And that means that you can trade your exemption back and forth with a spouse. So that's to say, if any of the 5.4 million exemption isn't claimed by one spouse upon their passing, it can be added to that used by the surviving spouse, as long as they aren't remarried. So that means that as much as $10.8 million can be sheltered from federal estate tax today in a survivor's estate as of 2015. That number will go up with inflation over time, but this is the number for 2015. The other good news is that finally estate and gift tax rates are unified, they're clear, they're unambiguous. It's a lot different than the previous 15 years when these rules changed every year, year in and year out. Now there is a bit of a kicker to this. Let's see. Let me move ahead to the next slide, which has to do with, so there's the portability number, and there's the federal estate tax number. But here's the kicker in this. Some states have estate or inheritance taxes that they levy, and the thresholds for those can be far less than they are for federal purposes. So if you live in any of the states that you see on the screen in either red or blue in particular, you're going to want to be sure you understand your state's statutes related to such taxes. So none of the states that have enacted their own taxes have made the estate tax exemption portable. All right, so not only do they have taxes that might kick in faster and larger, but they also don't allow you to trade back and forth with a spouse. So this means that where there's a gap between state estate tax and the federal estate tax exemptions, and I'm going to use New York as an example. So let me go ahead to the next slide. So in New York State, just an aside here for a minute, this is what's going to happen. It is going to catch up to the federal exemption amount. But as of now, it's still leaving a gap of $2.3 million, basically. And for married couples, they need to include special planning in their wills and other planning documents to take advantage of each other's exemption amounts and not lose out. So just be aware, if you live in a state with a state inheritance or estate tax, you want to be sure that you're not losing out and having to pay a bunch of money to the government. Go ahead.
Greg, let's just take 1 minute because we do have a polling question where people in the audience can let us know if they're in New York State or outside of New York State. That is up right now in the, is that up in the chat box, Jerome? Okay. So yes, if you can answer that polling question, that would be super. It looks like maybe you all already have. Okay. Thank you very much. Sorry, Craig.
All right. So one of the most significant provisions in New York is that the basic exclusion amount, basically what happens is if your estate is valued at more than 105% of the basic exclusion amount, so that would be for 2015, this year, $3.1 million. The state then levies its tax of 16% against the entire value of your estate, not just the amount that would be in excess of the exemption. It can be quite painful. So that's something to be careful about and aware of when you talk with your own lawyer about how your own will ought to get set up. So if this applies to your situation, you're going to want to ask about what are called bypass trusts. And that simply means they bypass estate tax. Any lawyer who does estate planning will know exactly what that is. And you can use those to pass more money tax-free to your heirs, to your spouse, etc. So bypass trusts are important. Okay, let's move on. So just to remind you, so there's a 16% bite in New York. It's not portable, and if it's 5% over the total amount that's exempted, they're going to tax you on every dollar. New York's a great place to live. Now, who pays gift tax? Okay, not the receiver, only the giver, okay? And only if the gift exceeds $14,000 individually or $28,000 as a couple per person per year, and not until you use your lifetime exemption. So that is to say, you don't actually owe any tax. You could give away $5+ million during your lifetime. You won't have to pay any tax on that money, but it'll leave you less to leave through your estate later. Okay? Income tax considerations. I'll let you read what's on the slide because I don't want to bore you with this. This tax law has been in effect now for a couple of years, basically. You've all done your taxes under this new tax law. You know what it means. Lots of people are paying more tax than they were before. But there's one silver lining to this that I want to be sure everybody understands, and that is that charitable gifts deliver greater tax savings under this tax law than they did before, all right? So the current rates are anywhere between 41.5% and 44.4%. So today, if you were to give a $10,000 gift to RIT, for instance, your marginal tax rate, if it's up in that bracket, you're going to be saving between $4,100 and $4,400 is going to stay in your pocket that you otherwise would have to pay to Uncle Sam. And that beats what was the previous tax law with a top rate of 35%. So in the old days, 3 years ago, you would have paid that $10,000 gift and saved $3,500. Now you can save $4,100 to $4,400. So there's a bit of an incentive for making charitable gifts. Okay? There's also an issue about itemized deductions and personal exemption phase-outs. They're known as the P's limitations and for itemized deductions. And they don't kick in for individuals until your income's over $258,000 and for couples over $309,000. What it means basically is your deductions will be reduced by 3% of the excess of your adjusted gross income over the threshold amounts. Now, I don't know about you, but as soon as I start talking like this, I start to want to glaze over and fall asleep. I like to leave this to my own accountant, frankly. What's important here is to know that most people who are in this category will see their itemized deductions reduced almost entirely based on paying their state income taxes and their real estate taxes and their mortgage interest. That's to say their deduction won't be reduced further by making charitable gifts. So if your accountant or your lawyer tells you that, no, you can't make more charitable gifts, that's probably not going to be germane to your situation because you will have already reached the limit based on these other taxes you pay. Let's see, is there any, and so bottom line, charitable giving has no effect on reductions in personal exemptions. That's the bottom line. Okay, so I'm not going to belabor that one. Capital gains tax. Now, this is an important one. The 15% rate was extended by the new law for qualified long-term gain and qualified dividend income for taxpayers who are below the 39.6% bracket. That's for single taxpayers with income below $413,000. All right, so long-term capital gain for anybody in the 10 and 15% income tax brackets still is 0%. Good deal if you're in that level of income. If you're above that $413,000 threshold, your rate's going to be 20% on capital gains. All right. And while that's an increase and made a lot of people unhappy, it could have been a lot worse. Congress was thinking about eliminating preferential tax treatment of dividend income altogether. Thankfully, it's not subject to ordinary income tax rates as Congress contemplated. Well, let's hope they don't go there, because that would make selling appreciated stock very painful. So let me talk a little bit about how capital gains works. When you sell it, what happens when you give it to family or friends, and what stepped up basis means. Some of you may recall that back in 2010, it was the only year that there was no federal estate tax for exactly 1 year. What most people didn't know was there was a little, basically unknown kicker in the law that said, instead, you're going to pay capital gains tax on everything, and it's going to be paid by whoever receives your estate. And that was unknown and, in fact, very expensive for some people. So the reason it happened was because they got rid of stepped-up basis in that year. So I'll come to that in just a second. So let's talk about stock. So imagine you paid $3,000 a few years ago for a particular stock, and today it's worth $10,000, right? And you decide you want to sell it. You want to have some money to buy a new car or put a down payment on something. And when you sell it, you'll pay a capital gains tax. And for most people, it's going to be 15% of the gain. In the example I just gave you, 3,000 basis, 10,000 fair market value, that means there's $7,000 of gain in that particular stock. You'll pay $1,050 in capital gains tax to sell it. If you're in a marginal tax bracket of 15% or less for this year, you wouldn't owe anything. But if you're in that 39% bracket or above, you'll pay 15% or $1,000. If instead, now let's go back to my comments about the annual exclusion. Let's say you wanted to give somebody $14,000 this year, children, grandchildren, nieces and nephews, friends. If you give the stock to somebody, you can do it under the annual exclusion, and you won't have to worry about the capital gains tax. If the person who receives this from you decides to sell it, then they'll have to pay the capital gains tax as if you owned it, all right? In other words, when you give the asset, you also give the $3,000 in cost basis. But it's still a pretty good deal for whoever receives it. And it's also not a bad deal for the donor because it means you no longer have to worry about paying the capital gains tax on the sale. If you wait and give that same $10,000 worth of stock to whoever it is you are contemplating through your will, through your estate, that person will get what's called a stepped-up basis. And what a stepped-up basis means is that the day you pass away, the basis in that stock is whatever it's selling for that day. So let's say it's selling for a total of $10,000. Then the recipient gets it as if your cost basis was $10,000, and if they sell that stock the next day, they'll essentially owe no capital gains tax. So sometimes it pays to wait to give appreciated assets through your estate, at least under current laws, because of what's called stepped-up basis. All right, now here's a concept that's important to know about but doesn't necessarily apply to a lot of people, but for those to whom it does, it's very important. There's a thing called the generation skipping tax. This is something Congress put in place because they wanted to make it especially painful for people to be passing things down past their next generation. So what I mean by this is from you, not to your kids, but to your grandchildren. And if you don't handle it correctly, it means you can end up paying 40 cents on the dollar on top of whatever other gift and estate taxes you might be paying. And this particular tax is not portable between spouses. So if you're thinking about giving any significant money, anything beyond that $14,000 or $28,000 a year to your grandchildren, you're going to want to get some sound financial and legal advice before you do that, all right? By the way, once this is over, if anybody listening in wants to talk further about any of these concepts or issues, I'm happy to chat with you by phone. Just let us know. So to sum up here, there are 5 things that are gift and estate tax free. You can see what they are here on the screen. It's that annual exclusion. It's anything you give or leave to your spouse, because that's 100% tax free. The government doesn't tax the first spouse on leaving everything to the surviving spouse. You can see $5 million plus given during your lifetime, given through your estate, or 10.8 with your spouse, and any gifts that you give to charitable organizations are gift and estate tax free. Okay? Alternative minimum tax. It captures an awful lot of this these days. If you're in it, you probably know, because either you figured it out or your accountant has mentioned it to you. Thankfully, it's indexed for inflation now, which is a help, but that's cold comfort for many people because they're still subject to it. But here's the important thing when it comes to charitable giving. Charitable gifts are not a preference item. They are not a preference item for alternative minimum tax. That means you can make charitable gifts and not put yourself any further into AMT than perhaps you might be already. So again, if you're advised that, oh no, you can't make any charitable gifts because you're an AMT, that's just wrong. And I'll be happy to talk with your accountant if that's what they're telling you. Have them call me. It still means you can benefit from charitable gifts, though probably at 28% instead of at a higher rate. So it might slightly reduce how much money you save, but you're still going to save money by giving charitable gifts. All right, for those of you who are in a position to be forced to take your minimum distribution from retirement accounts, you want to pay attention to what are called the IRA rollover gifts that have been available to all of us in the last few years. If you haven't taken your minimum distribution, I'd advise that you consider waiting until December to see what Congress does, because they usually make this law effective retroactively for the year and often do it late in a tax year. But what it means is that people over 70.5 can give up to $100,000 from their retirement account, be treated as if they have not taken that money as income at all, so they don't see their tax bracket rise. And it counts as their minimum distribution for the year. So if you know anybody who's saying, oh, ouch, I have to take my minimum distribution, I'm over 70.5, I don't want to do that this year, you might want to mention this IRA rollover option to them and have them keep an eye out for how Congress handles this. That may very well come back. We still hope that it'll become eventually permanent, but for now it's been done on a year-to-year basis. Okay, I think we have a polling question that comes up at this point. I'd like to know, among those listening, who has a current will? And since this is anonymous, we'll never know what you said, but I'd love to know what's going on with everybody on that front. Okay, have we? Okay. No answer, some yes. Okay, well, here's the fact, folks. You can see it on the screen. 6 out of 10 Americans die without a valid will. If that's your circumstance, if you don't have a current valid will, regardless of your circumstances, certainly important if you're married, if you have children, people who depend on you, but even for young, single, relatively new college graduates, working in jobs where they get life insurance, etc., you want to be sure that you've got a good will, and they're not expensive to do. The older you get and the more complicated your financial life is, sometimes they get to be a little more complicated and more expensive. But not having a will creates tremendous trouble for survivors, because at least in New York, for instance, what happens is surrogate court comes into play, and they basically act in your place, and they take largely forever to resolve these things, and often survivors are left without access to income or assets for a very long time. So write a flexible will that can change with the threshold. So whatever lawyer does this for you needs to put in the language so it says whatever the exemption amount is, not an exact amount, not 5.4 or 10.8 million, but references the exemption amounts for the federal and state purposes. And I encourage you to include a percentage bequest for your charitable interests, your church, your synagogue, RIT, a museum that you like, whatever. But percentage bequests are the best way to go, because if your estate increases in value, everybody wins. You're not shortchanged, and your charitable interests get to see the upside of that. On the other hand, if you need to use a lot of your asset value, for instance, for long-term care or something else, then your family and your heirs won't be shortchanged if your estate decreases in value. I also suggest if for anybody who's got lots of asset value that's above the thresholds we've been talking about, that you talk with your advisors about moving assets. Say, use your annual exclusion, use your lifetime exclusion. It's easier and less expensive for money to accumulate value in the hands of your heirs than it is in your own if you don't need it. Here's something else you need to have, folks. A durable power of attorney. Not just a power of attorney, a durable power of attorney. So when you go to have your will done, or if you've got a will and don't have a durable power of attorney, go get one. It gives somebody else the power to act in your place. So let's say you're suddenly incapacitated because of a stroke or a heart attack or bad automobile accident or something. Without a durable power of attorney, if that happens to you, your family will have to go to court to be granted the authority to act in your place, all right? And for anybody who has what's called a living trust, you want to have a durable power of attorney for any assets that aren't included in that trust. Okay, so important planning point, durable power of attorney in addition to a will. You'll want both. Living trust, okay, what's a living trust? We see lots of people doing these today because it gives families a lot of control over what's going to happen. They're becoming increasingly popular, and it basically sets up all of your, takes all of your assets, puts them in the living trust, and you can be your own trustee, and you can designate a successor trustee. So if you're suddenly incapacitated, it could be your spouse, it could be one of your children. They can immediately begin to act in your stead. They're already named in the living trust. They can pay your bills. They can take care of everything that you would otherwise be able to take care of yourself. Just be aware, it won't save estate taxes, all right? So this isn't the kind of trust that'll help you save money. It's the kind of trust that'll help you control assets and who has the authority to act on them, all right? So worth doing. They cost some money to set up. Might cost you $4,000 or $5,000 to get a living trust set up, but what you will avoid is your estate won't go through probate upon your passing. And so you won't pay any probate fees, all right? And your lawyers don't need to get paid as much as they would otherwise because you have already worked with them to set up a living trust. So worth considering as a good way. If, as I say, even if you have a durable power of attorney, people do both of them. It's not an either or.
Craig, I think we've got your last polling question up and ready too, which is whether or not the people in our audience actually know what their current net worth is. So yes or no. So this is, do you know what your assets add up to? Do you know what your debts add up to? And have you done the math to figure out what's left over? If the proverbial bus runs over me today, this is a calculation I've done and I do from time to time, and it's important for planning purposes for you to know this. So I see that there are a few of you who do know, some of you who don't, and others who haven't answered. But if you haven't done that math, it's worth doing. Certainly worth doing, so you know that you know what your exact situation is. All right, let me take you on to the idea of charitable giving and receiving income for life, okay? So yes, it's possible to make gifts that will save you tax, increase your income, and help you avoid estate tax. It'll also help you avoid capital gains tax if you use appreciated assets to do this. And RIT and lots of organizations offer these kinds of arrangements.
But basically, here's the shorthand. It's the income can come to you and your family, and the assets underlying this arrangement end up with your charitable interest or interests. You can arrange these so that they can end up going to more than one place. So you could have an arrangement like this that says, upon my passing and that of my spouse, I'd like 25% each to go to 4 different charitable organizations, or 50-50, or all to one place. I'm going to leave this slide up for a minute. There's a lot here. It's worth absorbing this if you're the least bit interested in it, and you may want to do that after I finish yakking at you today. Here's the idea. So let's say you've got $100,000 in, and you pick the number. It could be 10, 100, a million, I don't care. But assume that you own something that's got a lot of appreciation in it, and every time you think about turning it into cash for yourself, you balk and think, I don't really want to pay the tax on that sale of stock or sale of real estate or sale of something appreciated that you own. Completely understandable. But let's say that it's not paying you any income. So this would be an example of like a growth stock that you might own that has grown a lot but doesn't pay you anything. And maybe you're getting to the point where you'd like to get some income off this money. Well, you could do a gift with RIT, for instance, where you would gift that $100,000 of appreciated value, and you'd put it in a trust, basically, and set it up. In this case, you can see it's for a married couple age 72. Age matters. The older you are, the bigger the tax deductions are on these things. But for a couple age 72, if they put $100,000 away of any of the assets you can see in that one little box and ask to get paid 6% a year, well, they'd be getting $6 grand a year off of something that perhaps they were getting little or nothing from before. And in this era of low interest rates, 6% is really a great return, because good luck trying to find that in the CD market today. If they live to their life expectancy, they're going to get close to $130,000 in income. Immediately, they'd get a $40,000 income tax deduction this year, and they'd pay 0 capital gains tax on this asset. So they put the whole thing to work for themselves. And ultimately, they're going to be making a charitable gift. This assumes an 8% total return, okay? So it means that the trust is going to make a little bit more than it's paying out. Eventually, a gift of $142,000 will find its way to RIT, and you can designate that for whatever you want, scholarships or fellowships or something that you know, really interests you. So that's how what I call life income gifts work. And they're done a lot in this country, and they come in a couple of different forms. One's like a mutual fund in that the income can rise and fall. The other is like an annuity where when you sign up for it, you get a guaranteed rate for the rest of your life, and it doesn't matter what happens in the market. Yesterday, today, or tomorrow, you'll continue to get that guaranteed amount, and often with some tax-free return of your own principal in the process, so that your after-tax payments are essentially greater than the percentage you get quoted. Okay, let me move on. There's a flip side, or there's an additional concept idea to this. So people who do these, you can see they get increased income, they get tax savings, and often they'll say, I've had people say to me, yeah, Craig, I'd love to give RIT that $100,000, but you know what, I'd like to give it to my kids. Okay, I understand that, but there's a way to do this so that everybody wins. And that is to say that you can make your children the beneficiaries and the owners of a life insurance policy that you can pay for with your tax savings and your increased income, some or all of it. And basically, you'll get that $100,000 out of your estate, arrange for a good charitable gift, and replace the value of that asset in your estate outside of your estate through life insurance for your children. So that's what I mean by wealth replacement strategy, okay? Now let me talk about the flip side of this idea. So the first one was about income to you and assets to a charitable interest. This is about assets to you or family and income to a charitable interest. This is something that will deliver assets to your heirs with significant estate tax savings. Sometimes 0 estate tax is paid. and provides current gift to a charitable interest, okay? This is a way for you to trump the $5.4 million or the $10.8 million limits. So very wealthy people like to use these as a way to get around those limitations, all right? I call it an estate tax savings trust. And here's another slide I'll leave up for a while that gets at this concept. So imagine for a moment that you're lucky enough to own a $500,000 piece of commercial property. It's a warehouse or an apartment building or 5 apartment buildings worth $100,000 each, you name it. And you're also lucky enough not to need the income from it. Believe it or not, that's true for a lot of people. And what somebody wants to do is try and get the value of that down to the next generation and not have it be taxed. So if you hold on to that asset and you continue to be successful and you see your assets grow, the potential for it to be taxed either by the state and or the feds also grows. So here's how to get it out of your hands in a way that your heirs end up with more. If you take that asset, and again, the options are the kinds of things that are in that little box there, in the upper right, and you put it in this arrangement, and you say, okay, I want to pay 6% a year to, I'll use RIT for the moment. So RIT is going to get $30,000 a year from this, and we're going to set it up to run for 20 years, which means that ultimately you'd be making a $600,000 gift in this way. And by doing it this way, there's also, imagine this real estate is going to continue to appreciate in value over the course of 20 years. And typically, when these things are set up for this length of time, and you can run them for anywhere from a year to 20 years, but on the far end of it, often and typically you'll see things grow by as much as 3%. And so you see that $1.5 million number, it's possible to pass that to your family at 0 estate tax cost. Why is that? That's because when you set something up like this to begin with, the IRS looks at it and says, okay, so you're going to give somebody $500,000, you're going to pay $600,000 off to a charitable interest or interest over the course of 20 years. We do a calculation at the IRS and says, well, you know, that's not like giving somebody a taxable gift today. So we will discount this gift as if it's 0. And so you can pass all of the appreciation to your heirs. It's a terrifically powerful way to get assets to another, to your heirs or even your grandchildren, and not have to let this stuff grow in value in your own hands. Okay, so 2 sides of the same coin. One is income to you and assets to charity. The other side of the coin, which is this one, is income to charity and assets to you or family. You can also give tangible personal property, art, antiques, and jewelry, summer houses. I'll come to that in a minute, but if you know people who own these things, or you do, and you're wondering about what to do with them, please ask your children, or ask their children if they really want them, because otherwise I've seen a lot of families, whoever accumulated these things, leave them in their estate, and their heirs turn around and end up selling them for pennies on the dollar. So either give them away during your life or by will. Ask whether or not charitable interests that you have would be interested in taking them and what the advantages of that would be to you. But don't just assume that your heirs want your art, antique, jewelry, or other tangible property that's got real value. Okay, for anybody who's involved in a family business, that's what closely held stock is. This is where, you know, maybe my sister started a business and I gave her the money, and so I own some stock in the business, but she's made it go and has made it tremendously successful. And now the 100 shares of stock outstanding are worth $10 million. So each share is very, very valuable, and ultimately or potentially can result in having to pay a lot of tax on paper wealth if I were to, you know, pass away unexpectedly. So this is also something that people can give away charitably and benefit their families in the process. So you can give closely held stock, and then the way it works is you'd walk into RIT and you'd hand me a share of stock and say, Craig, I want to give this to RIT. While we can't have a written agreement to this effect, at least we can agree that we'll have first right of refusal to buy it back. But I'd like you to hang on to it because the company's going to come to you and want to buy it from you. We actually want the stock back, and we're happy for RIT to get the cash that it represents. And either the company can buy it back and retire it as treasury stock, or a family member can buy it, and that way you can pass the value of the company to the next generation slowly but surely. Or even an ESOP, that's an employee stock option plan, can buy it back from RIT. So this is a business transfer methodology that some people use. You as the donor would get a tax deduction for the fair market value of the stock. Ultimately, whoever you give it to gets the cash. In that case, it might be RIT. Nobody pays any capital gains tax. So it's also a powerful way to give away assets that often people are thinking, gee, you know, I can't give this kind of asset to charitable interest. Yes, you can. And, you know, anybody who's in the business with you may want to say, why the heck do we want RIT to be our business partner? And I can tell you, we don't want to be your business partner. We'd like you to give us stock in that way and have the company purchase it back, or a family member or an ESOP, as quickly as possible. All right, we're happy to hang on to it until that happens. But we're interested in what it's worth, and you're interested in having it back to be able to control your corporate interests. So, real estate. All right, a lot more of us own that probably than closely held stock. You can give real estate to family. You can give it to charity. You can give what's known as an undivided partial interest, and that's the secret that I love about these kind of gifts. You can give it away outright, or you can give it into a trust, the kind of trust I described earlier, where I talked about $100,000 in stock. You could put that $100,000 worth of real estate in something that would pay you, your spouse, your heirs income instead. An undivided partial interest, what's that mean? So let's say I've got a $100,000 piece of property, raw land. You know, I know it can be developed, so I know it's worth that much. I've had it appraised. And I want to make a gift to RIT. So I say, okay, can I give part of the property, but do I have to go to my lawyer and the county and get it redeeded and, you know, carve off this little piece for RIT and say, you guys own that? The answer is no. You can give what's called an undivided partial interest. That is to say, I want RIT to have 10% of this property, $10,000 worth. I'm going to give them an undivided partial interest. It's basically a partnership interest, and it means that anywhere your foot lands on that property, 10% of the real estate under your shoe belongs to RIT, all right? It's as simple as that, and you get to keep the control over when you sell it and for how much, and when the buyer buys the property, they write you a check for 90%, and they write a check to RIT for 10%. The advantage to you up front is as soon as you do this, the day that you create an undivided partial interest, you get a tax deduction for $10,000. You also don't have to pay any tax, any capital gains or ordinary income tax on that 10% value when it does, when the transaction occurs. You can also give your own personal residence. Now, this often matters to people who are anticipate living in their house for the rest of their lives, but the house is paid off. This may represent a significant asset for them. They'd like to make a gift, but they don't want to burden their family with the idea of having to empty the house, put it on the market, find realtors, etc. You could go to RIT or another charity and say, I'd like to give you my house through what's called a retained life estate. What that means is that you get to retain the use of the property. You keep the keys, you keep painting it, you cut the lawn. RIT can't come and knock on the door and say, excuse me, can I come in and see my house? Doesn't work that way. But the advantage to you is you can get an immediate income tax deduction for a portion of the value of the house. Your family won't have to worry about disposing of it later. And not only does it work for your primary residence, it works for farms and ranches too. So another concept for how to give real estate. Retirement. This is what I call the double tax threat. So it's possible for 80 cents on the dollar of what's sitting in retirement accounts to end up with Uncle Sam. Now, that applies to people with taxable estates at the federal level. That's not a lot of people today. So for the rest of us, there's a possibility of 35, 40 cents on the dollar going to Uncle Sam, all right? This is the most onerously taxed asset any of us own, depending on our circumstances. And if you know you want to make a charitable bequest to any organization, this is the money to do it from, because any of this money you give away goes tax-free. No income tax will be due on it. No estate tax will be due on it. and it will enable you to leave more of the rest of what you own to the people you want to have get it. You also can do this basically for free. You don't have to go to a lawyer and have your will redone or anything else. You ask your plan administrator for a new beneficiary form, and you fill it out. It says 90% to my spouse, 10% to RIT, or if you're now the surviving spouse, it'll say 100% to RIT. And that way, this asset that otherwise has a lot of accumulated income tax waiting to be paid won't be subject to any tax at all. So if you're thinking about a charitable bequest, think about using your retirement funds or part of them to make that gift. You can also give life insurance. If you've got paid up life insurance policy, it's got real cash value. You may not need it anymore. Your children are grown, they're out on their own, you've got plenty of other assets. You can give away life insurance and take a tax deduction for what it's worth. You can also buy a new policy and pay the annual premiums if you want as a gift to charity, but that doesn't work quite as well as the idea of giving away a paid up policy, which is money that you can turn into a nice tax deduction for yourself in the process. So I'm going to turn this over and answer any questions that any of you have. I want to thank you all for staying on the line with me because this is not always the most exciting topic in the world. But here are my key takeaway messages for you before we take questions. Make gifts to family and friends using your annual exclusion, number one. Number two, have a will and or update a will. If you've got one, be sure it's up to date. And be sure to take advantage of the current permanent changes in estate tax, all right? Be sure your will is written in such a way that you don't get caught up in changes in what the thresholds are, that your will be flexible enough to go with that. Use bypass trusts if you need to if you live in a place like New York. So be prepared with a flexible will and a living trust and or a living trust that reflects current tax law. Those are my basic takeaway messages. So I'd be happy to answer any questions.
Okay, we do have a couple of questions, and if anyone else has questions that they want to ask, please enter them in the chat box. So here we go. First question, referring back to what we would define as a gift. We're understanding that gift includes both money and a tangible asset like real estate, property, antiques, what have you. Is there any kind of advantage to giving the asset versus liquidating it first and giving the money, or does it not matter?
It does matter. You want to give the asset directly as opposed to liquidate. The only time you want to liquidate an asset is if you've lost money on it. So if you own stock that you've lost money on, sell it, because you still get to take the loss on your taxes, and then the proceeds can be used for your gift. But if it's worth more than you paid for it, if it's appreciated, real estate, appreciated stock, give it directly, because otherwise, if you liquidate it, you have to pay the tax on it. And then whatever's left over, you can give to charity. Give it directly.
Okay. We have one question regarding life insurance, that we didn't think that life insurance was taxable to the beneficiary.
Yeah, I don't know if I gave you that impression. I certainly didn't mean to. Life insurance is not taxable to beneficiaries, okay? But when I was talking about gifts of life insurance, I'm talking about paid up policies that perhaps someone feels they don't need anymore. And those are something that there's a value there that you don't have to take money out of your checking account or value out of your retirement account or your stock portfolio to make a gift. So let's say there's a campaign at your church or synagogue or university and you can't think of any other way to make a gift. That's one to keep in mind, and that's all I meant.
Okay, thank you. One more question. All right, in the whole category of wills and net worth, one of the biggest debts that many people are looking at right now is student loans. What happens to a student loan if you die before it is paid? Should you make accommodations like a life insurance policy or something specifically to pay off that student loan? And what if you are the parent who has co-signed a child's student loan and you die before the loan has been paid?
Okay, so I'm going to give myself a get-out-of-jail-free card here and tell you that if that's your situation, go talk to your accountant because it's more complicated than I can answer for you right now. The fact is, whoever dies with debts, your estate is bound to have to pay them. Is it possible to end up bankrupt? Yes. I'd go see your accountant about this issue. It seems like a big stretch to go take a life insurance policy out to cover your student loans. But if you still own student loans when you're 50 or 60 years old, well, then you got a whole other problem to deal with, and I'd say go see a good accountant and get some good financial advice.
Okay, one more question. What is the tax impact of a charitable annuity on Medicaid? Will it be viewed as a gift that should be returned?
Are we talking Medicaid or Medicare? So I'll tell you what I know about if you were to make let's say you give a charitable annuity, okay? And I think you may be referring to giving money away perhaps to family. There's what I think I'd refer to as kind of a clawback clause, where if I were to give a lot of my estate to my kids and die within 3 years, you know, the tax authority is going to say, no, we're going to claw that back and call that your money, not their money, and tax you on it. But a gift annuity or any of these life income agreements, once you give that money away, you no longer own the asset, period, the end, and it can't be clawed back because it's a gift to charity. The best or worst, I guess, that would happen is that they could try and get the income from you that you're getting from that. But the underlying value of what you put in the gift annuity, nobody gets that until it goes to the charity that you gave it to. And they can't come and take it back. So no, it's not a gift that should be returned, or that would have to be. Okay.
Thank you, everyone, for your questions. If you have any additional questions, they can be emailed to ritalum@rit.edu or tweeted to @RIT_alumni with the hashtag #MeRITWebinars, and we will direct your questions to Craig.
And if you want to chat with me by phone about any of this, in that message, just give me a telephone number and a preferred time of day or day of week, and I'll see if I can reach you by phone and we can talk.
Terrific. Thank you very much.
Thank you very much, everybody. I appreciate it.
Okay, so note that all of our participants will receive an email from us in the next few days. It will have 2 links. One to today's webinar recording, and one to a document of highlighted information from Craig's presentation that you will find useful as a future reference tool. Our great thanks to Craig for being our distinguished speaker today, and thank you all to our listeners for joining us for today's webinar. Our next webinar is scheduled for 1 week from today, November 18th. You'll want to join us for Patent Trolls Beware, Patent Protection and Searchable Database for Graphic Arts Technology Users and OEMs. Our presenter will be Harvey R. Levinson, PhD, an RIT alumnus from the class of 1967. Dr. Levinson is Professor Emeritus and past Director of the Graphic Communication Institute at Cal Poly. Thanks again to all of you for joining us. Please exit the webinar by simply closing your WebEx window, and please do let us know what you thought of the webinar through a brief survey, which will pop up when you exit. Thank you, and have a great day.